I'm Kyle Malnati, your host of the Calibrate Real Estate Podcast. At Calibrate, we exist to help people create generational wealth through real estate. My personal mission is to encourage, empower, and educate you by sharing best practices from business leaders that are proven winners. Broadcasting from the Mile High City, thank you for tuning in to episode 176 of the Calibrate Real Estate Podcast. I'm your host, Kyle Malnati. Our guest expert today is Jacob. I'm going to call him Jake Vanderslice of VanWest Partners. Jake, you and I have met in person a couple of years ago. We're both here in Colorado. Welcome to our show.
Thank you, Kyle. Great to be here. Thanks for having us on today.
It's going to be a fun conversation. So Jake and I got in touch with each other because he was doing an adaptive reuse development right next to a listing of mine. For those of you that know Colorado or in Denver, it was right at 22nd and Welton. And we got to chatting. We got to talking about his business model years ago. Now, since I'm now getting updated, he's working more in the self-storage industry and raising capital, raising money, raising a fund. And it's just such an interesting concept because most of the business that I work on, Jake, is in the multifamily space, in what you would call habitational residential, whether it's someone's personal residence or it's an investment property. Self-storage, I can tell you from working in the residential real estate business, a lot of people are moving out. They're downsizing, they're right sizing, and man, they need storage. So what is that industry like from a return standpoint? What do you look for as an investor in that space? Just kind of, let's talk about some of the fundamentals that may be different in self-storage versus other types of real estate investing.
Yeah, self-storage, it's a fascinating asset class. It's very operationally intensive, and that's a common misconception a lot of folks have. They think it's kind of a fire and forget business. I would liken it most to the hospitality business, which I know seems like a stretch, but the reason I would do that is the revenue management's very dynamic. So rates are changing by the week and to a degree by the day. They're all month-to-month leases. Hospitality is obviously night by night. There's no lease. You have people moving in and moving out constantly. So it's a consistent ebb and flow of managing your revenue and managing your expense loads. We have got 30 self-storage facilities around the country. We've got a number of them here in Colorado in our backyard. I wish we had more, but it's been a challenging market for really any asset class to find yield. So we like the Midwest a lot. We like the Southeast. And self-storage is really the only line of business that we've been in over the years. We've done over 1,000 residential fix and flips, adaptive reuse retail. It's been the only line of business we found that we could scale effectively with consistent, repeatable returns and some enterprise value, and that's why we like it. It's been a good asset class so far.
Well, you mentioned one of the things that I think is important for all of us to hear, that yield for investors is critical. And when you've got property in Denver that has, what I would say in most of the conversations I have with different investors, Denver tends to be more of an appreciation market than a yield-driven market. And so people end up getting these great storylines over 10 years because they bought something at a price point and it's accelerated, it's appreciated to another price point, but the yield year over year, month by month may not be that great. So what do you look for as you're looking out of state, and how do you navigate that with, I'm sure, a myriad of different brokerage companies, different industry experts? I would imagine that's something that as you're ramping up and as you're building a portfolio of 30 storage facilities and growing, that probably understanding and navigating a different marketplace is probably something that has quite a steep learning curve.
Yeah, there's three types of storage deals out there, really storage strategies. The first is ground up development, which we've done. And just like ground up development with multifamily, it's capital intensive, it's risky, but there can also be a lot of value creation, but with a lack of cash flow during the development period and the lease up period. The second type of deal that we do is conversions from a prior use into self-storage. So we converted a multi-story office building into self-storage. We've converted industrial buildings into self-storage. And the third type of deal that we do is just buying existing storage facilities and adding value with capital improvements and management efficiencies. So in terms of yield versus appreciation, from a risk perspective, there could be a lot of value created doing a heavy value add acquisition with no cash flow, but then upside later. But that upside later is tough to quantify. You can't really forecast appreciation. You can look at historic trends and you could say, okay, this MSA is gone up 15% or whatever the number might be in the last year. But how do you look forward to have some level of confidence that's going to continue? So we try to blend the appreciation component with a cash flow component along the way. So we like upside down the road. We're longer term cash flow investors. Our hold periods are at least 7 years, sometimes longer. So for example, we've been in the business for 5 years in self-storage. We've never sold or round tripped a self-storage facility. And that's been by design. So we try to find deals that blend yield and appreciation. Appreciation is tough to quantify and tough to predict. Yield is a little easier to quantify and easier to predict. And we think that creating wealth in real estate is about passive recurring revenue streams. So if you have a project that doesn't create a lot of yield, but it by default somehow appreciates over many years, the only way to capitalize on that appreciation is to refinance or sell it. And a refinance is a great vehicle to get to your equity tax-free, but you didn't have income along the way, or you had a nominal amount of income along the way. So in short, we like to blend both of those together.
That's great. And something I share with a lot of investors that meet with me, and they'll say, well, how do I get both? Oftentimes they'll say, well, you need to focus on either yield or appreciation. And if you own something long enough and you focus on the yield first, you tend to get appreciation over time. But if you're focused on that yield, you'll get it. And then also if you're focused on appreciation, you'll get that, and maybe you get some yield along the way as prices rise. So I think it is important that if you have these two targets of yield and appreciation, if you try to hit both, you're going to miss. But if you look at, in your case, yield, and then hope for and try to build for, and maybe sometimes you're pleasantly surprised, but that appreciation part of it is going to come along the way. I think that's smart. One of the things you mentioned at the beginning of our interview that I want to park on for a moment is that this business is operationally intensive, and you likened it to hospitality. How many staff members do you have? How do you build the model of pricing? Because it sounds like if you're pricing things day by day or week by week as things kind of surge, how does one, and obviously you've built a model, and we're not going to get too far into the weeds of that, but how do you even approach that so that you can make sure that you're pricing correctly and keeping occupancy levels up?
The first thing we look at on a potential acquisition are the supply ratios in the submarket. So self-storage is very local supply sensitive. So we're looking at supply ratios in the 1, 3, and 5 mile trade radius. Generally, nationally, there's about 7 square feet of self-storage per capita across the country. Once you get into a submarket that's over 8 or 9 or up to 10, you start to see a decline in occupancy and rates. And then likewise, if you're under 7, maybe down to 5, sometimes lower, you tend to have more buoyant occupancy and more buoyant revenue. In terms of the revenue management side, that's a tricky aspect of the business because, so for example, I would say the polar opposite from self-storage in terms of revenue management might be a triple net industrial lease to Amazon. So you sign the lease, you can predict your income stream, assuming they pay, which they probably will because it's Amazon. You can predict your dividend yield and your income stream for the next 10 years. Self-storage, because they're all month-to-month leases, you have a seasonality component, the peaks and troughs of summer versus wintertime, depending on the market. Seasonality, for example, in the Florida Panhandle is very different than the seasonality in Milwaukee. So in addition to the supply ratios and kind of being able to forecast out that seasonality, one of my partners, Aaron Westfall, we go back to junior high together. We've been partners since 2009. He's a software engineer by training. And I have another partner, Wade Buxton, too. I can expand on him if we get a chance. But Westfall wrote basically the MLS of self-storage software. And that software scrapes all the top operators' websites every day and pulls down their rates. And so we can analyze, we can draw a box around a given submarket. We can see that a 10 by 10 non-climate controlled unit is leasing for whatever number. And then not only does it scrape those rates every day, but we now have thousands of data points going back years of historic pricing. And you can see, for example, when a new facility opens up, like a public builds a new facility by an existing facility, you can see all those rates go down because of the competition. And another example too, which we love to look back on, is when a hurricane comes through Florida. You can see a spike in self-storage rates for the next 6 months because everybody's vacuuming out their houses and doing flood mitigation and whatever. They need storage solutions, so occupancy and rates go up. So understanding that seasonality and that revenue management component, in addition to the supply ratios, are really critical in making a good acquisition decision.
Well, you brought up something that I think is really important for a lot of real estate investors is quality partners, finding someone that has a core competency that's going to be different and complementary to your strengths. So let's talk about the software program. And I think about a couple of clients of mine that actually own a vintage car business, and they did a similar thing where they created a software system that scrapes Craigslist and all these different other websites for people that are just selling cool old cars, and then they repurpose them. They have this proprietary system where they've got everything photographed at their warehouse, and then they sell them nationwide. And you probably know who I'm talking about. And
I do. I've toured their building. They're in
yeah,
North Park Hill, right?
that's right. Yep.
Yeah.
So the
Great
Phillips brothers.
business.
Yeah.
Yeah.
And
I should not go in there with my credit card ready to go. There's some tempting purchases to make.
Yeah, but if you're looking for a CJ from the 70s, you can find it. It's pretty cool to see all the old vehicles. And I think about your business model. It's critical, right? If you're going to be in multiple markets, you really, and it is hyper local, hyper focused, you really do have to have that daily checkpoint. And so having a software system that scrapes all that information and brings it to you just gives you that much more decision-making ability. And so let's talk about your partnership and talk about different people and how you sort of select power partners with creating and scaling a business like this. Because I would imagine with the amount of equity you're raising, but also the operational side of it, you've really got to have good people that are making sure that they're covering their core competency.
Yeah, culture is a really important thing in our shop, and we're always striving to improve our culture. We've made some amazing new hires over the last year, specifically in the last 2 months. We brought on a new controller who was CFO of a title company, brought on a gentleman who was at Public Storage for 7 years and then the auto parts business thereafter, brought on a property manager who was the head property manager of Zeppelin. You might have come across some great guy, Daniel Nunez. And we've got a great talented team. So there's about 30 of us, including my two partners. And I would say a third of that staff is here in our Denver office, and the rest of our staff is at our various storage facilities around the country. But having good people and talented people is critical. For many years, we thought that we could just basically bring people in at a discount, and many times you get what you pay for. And we realized after a lot of business coaching and analysis and thought that we just need to find the right talent and empower them to kind of help grow our asset base. And it's been successful so far. We're still screwing up every day and still learning, but we're a lot less stupid than we were last year and the year before.
Learning experiences and trial by fire for sure.
That's right.
And as I say that, I would imagine that you've got these two different staffing situations. You've got your headquarters and you've got your people here in Denver, which in some ways may or may not be easier to operate, right? Because you get to see each other, at least get to communicate with each other. You can have an impromptu meeting if for some reason something comes up. But picking these partners at your actual facilities that may be hundreds, if not thousands of miles away, I think back to some of the evolution of self-storage, back in the 80s and 90s and even the early 2000s, where it was really a family kind of mom and pop business. There's a lot of theft. You kind of have the manager with a cigarette hanging out of their mouth, living in the management office, and self-storage has really evolved a lot. It's become a very competitive. There's a big corporate aspect to it. There's obviously big national publicly traded players in the space. So let's talk about that part of it, of how you select some of these hyper local operators of your site so that you can make sure that you're giving a yield and a good return to your investors.
Yeah, we'll touch on the management side for a moment. We used to outsource all of our management to third-party publicly traded REITs, and those are great shops. But we found over time, after the honeymoon was over, that our interests were not aligned like they should have been. And quite simply, they don't care about your deal as much as you do as an owner. So we formed our own management platform about 3 years ago. It's called Clear Home Self-Storage. And we now self-manage almost all of our facilities. And the flight I'm taking today, we're actually going up to Milwaukee. We have a 4-property portfolio up there. It's about $40 million with a partnership. CubeSmart was managing those, and they did a good job, but we just found that looking at their expense loads and the alignment of our interests, that it made more sense for us to manage those. So we're transitioning all those facilities actually today into our Clear Home brand. And we think we'll see an immediate effect on our expense load and our NOI. So for example, there's snow removal and landscaping contracts. They use national vendors, and basically just don't bid them out. And we got new snow removal and landscaping contracts, and we're going to save about 55 grand a year just on that expense line item between these 4 facilities. And that's not because we're heroes. It's just because we dig a little bit deeper and we care a lot because we own them and we have a dog in the fight versus being a third-party vendor. When I mentioned earlier about self-storage being operationally intensive, I didn't quite answer your question when you wanted me to expand on that. So I'll take a moment to do that. We manage our facilities really kind of 3 different ways. The first way is we have facilities that are single-story, non-climate controlled drive-up units, like typical self-storage. Those are not staffed with a full-time person in a leasing office. We experimented with running those deals completely remotely, basically with a 1099 rover who would go check in on it once in a while. And like many of our experiments over the years, they didn't work very well. So we manage those facilities from basically as satellite locations from another deal that we own about a mile away. And this is similar in a couple different markets. So that's one strategy we have. We have kind of a captive person who's overseeing it, but they're not there full time. And with technology today, customers can lease their unit online, make their payment online, get their gate code online. So you don't really need someone in an office. On our bigger facilities, we do have those fully staffed. Typically, if it's 40 or 50,000 square feet or higher, there's a full-time staff member in a leasing office. And in our climate controlled facilities, specifically our multi-story climate controlled facilities, those are staffed with a full-time person in a traditional self-storage leasing office, but they do not have a cigarette hanging out of their mouth. And it's a nice office in general. So if you're not staffing self-storage adequately, bad things happen. You talked about theft earlier. And, whether you're a mom and pop facility or a public storage, downtown Denver, especially in urban settings, you've got homeless issues. You've got people sleeping in units. You've got people doing drug stuff, stolen vehicles, stolen goods. We see a lot of stolen bikes and like speaker equipment. We had a guy once set up shop in a unit. Our owner user office building here in Denver is about Broadway and Evans, 1830 South Bannock. And we have an office upstairs, and we have a pretty small self-storage ground floor climate controlled component as well that just kind of offsets our overhead. And a guy set up shop in one of the units and ordered a pizza to his storage unit. And we've never seen that happen before. So that's kind of just briefly touching on the operational side. People tend to do bad stuff sometimes in storage units, and we try to mitigate that as much as possible. But I guarantee you in one of our facilities or more tonight, someone's going to be putting their mattress down and bedding down for the night. That just happens.
Yeah. And part of it is, there's a sad part to where things are economically and where we are culturally, where there's a big divide, right? In what people are doing. And you think of the homeless, different encampments, and there's all sorts of supercharged discussions that we won't have here about that. But you think about a self-storage facility, especially if, even if it's a, non-climate controlled, it's a roof over your head instead of sleeping outdoors. And at the same time, there's illicit activity. There's also, on TV, and I know that there's all these made for TV types of things, even in residential real estate. You think of storage wars, you think of some of the stuff that can happen with storage facilities. How much of that is accurate? I mean, it sounds like you've had some experience with obviously some crime around it, but do people just up and leave their stuff, and do you have to deal with that? And how does that all look from a reality standpoint?
Yeah, no, that's a great question. So in self-storage, unlike residential, there are no fair housing laws. So if someone doesn't pay, the first line of defense is they get their gate code turned off. And if they don't pay long enough, they get an overlock on their unit. And if still longer, they end up getting their contents auctioned. And those auction proceeds, it's kind of like a foreclosure auction to a degree. If the proceeds satisfy their rent obligation, the additional proceeds go back to the customer. But it happens pretty often. People just fall on hard times, whatever might happen, they don't pay. So you have to go through a process. While there are no fair housing laws, there's still a legal process you have to follow. It takes a couple months to get somebody all the way out. But we certainly see that. We run auctions about once a month, and it's a challenge in the industry for sure, but it's the reality. You're always going to have some defaulting customers.
Yeah, and it's a situation where I could see how this develops. A lot of times you have some great customers that just need some extra space while they're moving around or downsizing. But then you also probably have people that are kind of on their last nickel. They've been evicted or whatever, and they just need a place to put their stuff. And all of a sudden you can see that downward slide. And I'm imagining that you probably have to deal with some difficult situations, and handling that, I'm sure, with a process and a system is probably really important. Any kind of wild stories? Obviously the pizza being delivered at one of your spaces. Any wild stuff that you can share that would be kind of just a glimpse into what the public storage or self-storage type of industry might bring from just some of those. I can't believe someone just did that.
Yeah, I think I've got more wild residential stories than I do storage, but I guess the wildest storage story I can come up with at our owner user building, we had a customer lease a unit and then default. He had a stolen U-Haul that he had switched out the license plates from and taken off the U-Haul decals from the sides of the truck. And it turns out the guy is a major felon, meth stuff, assaults, like all kinds of stuff. He's been in and out of jail many times. So we called the cops up and we told them about him, and they kind of gave us his profile. They said, call us when he comes back. So a couple of days later, he comes back, he's hanging out in the parking lot, and the cops show up, like 4 cop cars, and we're upstairs, just glued to our windows, watching this thing go down. So the guy's in the parking lot, and the cops come out, guns drawn, like 4 of them. It's like a movie, and they're holding him at gunpoint, and he reaches in his pocket, and we're thinking this is not going to go well. And he pulls out a meth pipe and throws it over the fence, thinking the cops aren't going to notice that I threw my meth pipe over the fence. And I couldn't believe they didn't pull the trigger when a known felon reaches in his pocket and is kind of posturing aggressively. So they took him down to the parking lot, arrested him. They were probably here for an hour. We had to fill a bunch of paperwork, and not sure what happened to the guy, but he's not storing here anymore, as far as I know.
Oh my gosh! Wow, it's not for the faint of heart. Let's put it.
No. It was a big takedown in the parking lot, and needless to say, none of us in the office got anything done for a couple hours as that unfolded.
Wow. Transitioning a little bit, you and I first met a couple of years ago in the adaptive reuse part of your business, retail, and I've got to wonder, just kind of COVID, obviously, and the pandemic, and how people sort of move their investments, pivot, and do different things. What have you been seeing just in a variety of different markets? Obviously, we've been talking a lot about self-storage, but what are some opportunities that you're seeing in commercial real estate, and what are some areas that you're steering away from, and kind of how has that worked for you as you maneuver, like all of us have, and try to figure out what the new economy looks like?
Well, during the financial crisis, I had been in real estate for a couple of years, and I got beat up pretty badly, but I would do it again because I learned so much. And I always am thinking about, and was thinking about, when the next downturn would happen. And I thought back in 2015, the Denver market's getting hot. There's a lot of multifamily construction. We've got to be due for a correction. And I was wrong, and then the pandemic kicks off. And we're thinking, okay, this is a major correction event. Assets are going to go on sale. We're well positioned to capitalize on some of the distress that's going to hit the market. And frankly, we didn't really see that. And most asset classes went the opposite direction, especially multifamily residential and single family residential. I mean, the market's hotter than it's ever been in both of those asset classes. And you would think that on the retail side, you would see a little more pain. And maybe you've seen this in your business, but we just haven't seen much on sale. And I think a lot of that is just because of the historically large government infusion of equity with PPP, giving banks the flexibility to modify loans and extend guys interest-only periods or defer debt service for a while. But the recovery is fully underway. And I don't know if the pandemic is going to be the catalyst that creates the next downturn, because it seems like we're almost out of the woods. We don't have to go too far down that rabbit hole. As far as what we're seeing opportunity-wise in our business, we're not seeing a lot of adaptive reuse retail opportunities. Again, that's tough to scale for us. We'd love to do a couple more this year, and we've got a few deals we're looking at in the pipeline, but from a yield perspective, they're tough to make pencil. Hard costs are through the roof. Subcontractor labor and materials are very tough to source right now. We've seen a number of guys that we know that run other strategies and other funds be successful with hospitality conversions. So a busted motel that didn't work out, they buy it, they convert it to multifamily, and they sell it, and it's a home run. Beyond that, though, it seems like the darling asset classes right now are industrial, residential, and to a degree, self-storage. We're not seeing any major obvious opportunities out there, like go do this right now. This makes sense. Yields are just so low and values are so, for lack of a better word, inflated. Maybe they're not inflated, but they sure feel like they are. The historically low cost of capital with interest rates right now, you can really pay a low yield on cost right now and finance it with very inexpensive debt and have a decent dividend yield. And that's really driving up values. And I'm sure you're seeing the same thing in your business. So in short, I don't know exactly where the opportunity is right now.
Yeah, it's interesting. I think you're definitely hitting on one of the opportunity areas, which is self-storage, because it seems to me as people migrate all over the United States, we're seeing that a lot in residential where people are moving out of urban centers, trying to find more space. And as they do that, they may need either temporary or long-term storage opportunity. We're seeing a lot of people that they're frankly tired of maintaining property and maintaining a big yard, maintaining whatever, and they're downsizing and they're looking for self-storage. Obviously, you said seasonally that happens quite a bit. I would imagine that that your business is positioned because of the fact that it's, I would say, fairly new in the overall grand scheme of real estate. You think of apartment buildings and housing. I mean, that's as old as the hills, and that's a pretty developed business. Self-storage is kind of a newer part of a newer niche of real estate, I would imagine, over the past maybe 50 years. And I think that it's been positioned, like we were talking about earlier, for better operations, higher touch, obviously technological advances, things of that sort. So I think that you're in a business that is going to be really positioned for some amazing growth, and as obviously already seen some. I've got to ask just a related question, but more of a personal question. Do you have some of these tenants, for lack of a better term, that have self-storage that are sort of lifers, that just always have self-storage, or is it a temporary thing? I've got to imagine that there's some people kind of meander into it saying, oh, I'm going to need storage for 6 months or so. And then all of a sudden they're there for 5 years with stuff sitting there in the storage locker.
Yeah, that's one of the unique things about the asset class. You mentioned this on a webinar that we hosted for our most recent fund a couple months ago. We did a poll. How many of you have had a self-storage unit? Most people said yes. And of those of you who said yes, how many of you leased that unit for longer than you thought you would? And almost all of them said yes. So that's the business. And people move in, oh, I'm only going to be there for 3 or 4 months. It auto drafts from their bank account or auto hits their credit card every month. They don't want to deal with the stuff they have in there, but they don't want to get rid of it. And oftentimes, if you would have just bought new stuff versus renting for 2 years, you would have saved money. One of our customers, we didn't own the facility back then, of course, but we have a deal in Wisconsin. This guy's been a customer there since 1988, and he's had 2 units all that time. So who knows what's in there or what his logic is. Maybe it's just stuff he doesn't want in his house. He likes to go tinker with it on the weekend. But in general, it's a pretty sticky customer base. I think our average duration of tenancy in our portfolio is about 9 months. We do have folks that come in sometimes and stay there for a month or a month and a half or 2, but almost all the time, people stay longer than they anticipate. And that's the business. And
I believe it.
I mean, I have a storage unit underneath me right now, and I pay our partnership rent every month. It's like $120. And in that storage unit, I keep my seasonal gear, like my mountain bikes, my skis, my golf clubs. And I've got a bunch of family heirloom furniture that I can't get rid of because I'm attached to it, but I don't want it in my house because it doesn't match the stuff in our house. So there it sits, and there it'll sit probably in perpetuity at $120 a month. And that's the business.
Like the proverbial hair club for men, you're not only the operator, but also a great customer.
That's right. Exactly. Yeah. I use the product we sell.
I love it. Well, I was talking to a client of mine that I sold an apartment building for years ago, and there were a number of garages on this apartment property. And one of the conditions of the sale was that they were going to be able to rent back one of these garages for a period of time, because this gentleman liked to restore old cars and just like to have kind of a workshop in this one single car garage. And I met with them a few months ago and found out that they're still renting that. And I would have thought that would have maybe been 1 year, maybe 2 years. It was 4 or 5 years later, and I don't see any end in sight. He said it's just great, and I pay the rent that I need to, and it's just easy to have it there. So I believe it. All right, Jake, transitioning into the final part of our show, I've got 3 questions for all of my guests, sort of rapid fire here, but they're deep. So are you ready for it?
Good to go.
All right. So Calibrate, our real estate brokerage company, and the name of this podcast, the definition of Calibrate is quite literally to iterate. It's to make adjustments, experimental results, taking external factors into account, allowing comparison with other data. Infused in our conversation today, as you had shared, lots of learning experiences, a lot of trial and error, lots of baptism by fire in the industry that you're in. What do you do personally, kind of personal growth, or maybe some just life disciplines that you do to calibrate your life on a daily basis?
Well, one of those things is I live and die by my calendar. I block time off to get tasks done. I've got a scheduling app. If somebody wants to book a call, they can use that to book time. On the more personal side, discipline and personal growth have been more difficult the last couple of years. I'm not making excuses, but we've got 2 boys that are 3 and 20 months. And those guys are, they're an absolute joy, but they are tricky. And a lot goes into them. So mornings, and then off to the office all day, and then all evening, just the fire drill of taking them for walks outside and playing in a messy dinner and bath time and different bedtimes and refilling milk bottles. Not a lot of time for workouts. And I'm definitely in a workout slump right now. I got a few runs in last week, and I'm hoping to get a couple in when I'm in Milwaukee. When you're at a full-time job, you're running and gunning, you're doing deals, you're raising capital, and you've got little kids. I've found it's tough to make that time unless it's like 5 a.m, which sometimes I do. So workouts when I can. I try to eat right. My evening routine, once all the fire drills are over, is I'm a voracious historic nonfiction reader. So that's kind of my downtime. So I read for 30 minutes to an hour every night. And people always ask me, did you read this real estate book or this business book? And I'm like, no. Did you read this biography? And they're like, no. I should probably read more about my business and my area of expertise, but that's kind of my decompression time every evening.
I love it. 2 follow-up comments. So my wife and I have what my friends affectionately call Irish triplets. We went from 0 to 3 kids in 16 months, and you do that with twins at the end. Now, we have, they're now, older elementary school age. We've got a 5th grader and then twins, they're 4th graders. So I feel you. That 3-year age down to toddlers, that's tough because they just have, they want to communicate with you. They've got a lot of energy, but it's still kind of tough depending on their development. And I'll tell you what, when kindergarten happens, it's like, oh my gosh, there's just levels of relief along the way. So you're there, you're almost there. You're in the thick of it though. So I feel you. We just started early, and thankfully we were young and had lots of energy and just kind of made our way through it. But it's having kids is such an interesting personal growth experience, because there's a lot of self-sacrifice you're doing for the next generation. And it takes a lot of work, takes a lot of effort, a lot of energy.
It's an amazing experience, as you know.
The second follow-up, and I have to dive into this a little bit deeper just for a moment, is having this desire to read about history, I think is really important. And I think that's intentional. Obviously it decompresses and it helps you kind of go through different things. But what about history do you apply to your business? Because I think the adage that you hear a lot of is, if you don't pay attention to history, it's bound to repeat itself. So what are some things, some storylines as you learn more and more about history that you pay attention to that may be evolving for us as a human race right now?
Yeah, most of the historic nonfiction books I read have a leadership component to them, and I love World War II history. I love the Revolutionary War. I love the golden age of Victorian exploration. And really, when you think you're having a bad day, like, oh, this deal's not going well, or whatever, we couldn't raise money in time, or the seller didn't accept our contract, you think about what other people have gone through. And it's not so much applying what's happened in the past to what's going to happen in the future. It's just really, it's understanding that everything is relative. No matter how bad your day is, you're not on an iceberg near the North Pole eating your shoes, right? And having your digits freeze off. So a lot of those stories, you just kind of help calibrate your mind to how relative adversity might be. Turns out that the days we have struggles are not that big of a deal.
Yeah, it's pretty amazing what people persevere through to really make it, in some of these incredible voyages. And then you hear about leadership through war and different things that happen. So I love that. I don't read as much about history as I should. I tend to be more the nonfiction kind of business book, personal growth and development. But I've got to ask one final follow-up question. As you learn about some of these historical leaders, who are some of your favorites for someone like myself that may grab either a biography or a period piece? What are some of the people you've liked to learn about?
So there's a book that I read recently, and I was so enamored by it. I bought copies for our entire office and gave them out. It's called In the Kingdom of Ice. And it's about a story back in the late 1800s. They thought that if you got far enough north, there would be a warm open ocean and you could sail over the top of the world and cut off a bunch of navigation time. Well, it turns out that wasn't true. There's ice up there. So these guys sailed very far north between Alaska and Russia. They got stuck in the ice, much like the South Pole explorations happened as well. They were on the ice for many, many months. They were eating their shoes, eating their dogs, and they ended up getting a couple of their boats off the ship and rowing into Siberia. And a bunch of the guys passed away, but a few of the guys made it out, and they walked over 800 miles on foot south through Siberia, got help, came back up to the camp where the guys who weren't healthy were camped out at, found out that they were all dead. And it's just an amazing book. It's so well written. A lot of the letters that the captain's wife was writing him are kind of paraphrased in the book. So you see the perspective of his wife holding on to hope that he's still alive and telling him what's happening. And he never got any of them, obviously, but it's a touching book. And once again, it just really makes any challenges that we go through in the business world very relative and seem inconsequential.
Wow, that's incredible. I'm going to have to pick that up. Tell me the name of the title again.
It's In the Kingdom of Ice.
The Kingdom of Ice. Awesome. Love it. All right. Second question is a question that is really important to me. It's one of those things that as you learn about different ways to calibrate your life, you think about, okay, I've lived some life here. I've had, 15, 20, 30, however many years a person might be listening to the show may have in work experience. And you kind of look back at your early 20s and you say, man, if I only knew what I knew now. And this question is a Dear Younger Me question. It's based on a song that I really like, where the author of the song, the writer of the song, is writing a letter to themselves when they were in their 20s and passing on different pieces of advice. So if you could go back in time, give yourself some sage wisdom, Jake, what would you share with your 22-year-old self?
There are so many things, but from a business perspective, I would tell myself, stop buying, fixing, and selling. Hold on to almost everything you possibly can. And we look back on the deals we've done over the years, and sometimes it's very enticing to sell. You have a big liquidity event, you have a big equity multiple, but then it's over. And you have a tax problem, you have a yield drag problem. I wish I could have told myself to hang on to good assets versus being so transactional. So years later into my career, that's our thesis to a degree. We like to hold, not indefinitely, but for a long time. And I wish I would have known that back in the day.
One of the best pieces of advice I've gotten along those lines is buy real estate and wait.
Yeah, time cures all sins in real estate if you can hold on.
Yep, absolutely.
Yeah.
And some of my clients that I have been able to work through generationally, our mission here at Calibrate is we exist to help people create generational wealth through real estate. And I've had some amazing opportunities where I get to work with kids and grandkids that, grandpa or grandma bought a property 50, 60, 70 years ago, and you just see what type of wealth it creates for a multitude of generations. It's really special stuff.
We see so many deals, and I'm sure you do as well, where a business owner bought a building 50 years ago for his plumbing company because he needed a place to operate and keep his trucks in. Held on to the plumbing company, held on to the building. Today, the plumbing company is worth $500,000 and the building is worth $5 million, right? We see that constantly.
Yeah, you think of there's plenty of storylines in Denver. I'm sure it exists all over the United States and all over the world where someone owns a restaurant that happens to have an overflow of parking, and all of a sudden that restaurateur retires after 40 years, and some developer buys it and builds a 30-story building or whatever on it, and it just has a huge event. It's really, really cool to see those stories play themselves out.
Yeah,
Okay,
that's why I love real estate, among
final.
many other reasons.
I completely agree with you, and it's just such a great asset class, and it's so much fun to talk about and learn about, and be a participant in. It really is. So, final question is a derivative of that last question. It derived because in episode 5 of the show, we're at episode 176 now, so we've asked this question quite a bit recently. We had a guest that was my professional coach, my career and life coach, a guy named Chris Oakley. And when he was in his 20s, he was answering that Dear Younger Me question. He was actually in a mentoring group of young men. The facilitator of the group had everybody in the group read a book called The Principle of the Path by Andy Stanley. And in that book, Andy Stanley has his reader write their own obituary. So Chris did this in his mid-20s. It really drove him for the next decade on mission, on purpose. I shared our mission at Calibrate. Chris actually helped me create that as a career coach. And tragically, 2 years ago, Chris passed away in a hunting accident. And as a way of remembering Chris and giving an appropriate memorial, I asked this follow-up question to all of our guests, that instead of an obituary, because that maybe feels a little bit distant, it feels like a newspaper writer would be writing about you. If you had a loved one deliver your eulogy, and hopefully that's decades from now, what would you hope your legacy would be? What would you hope that they would share with the crowd at your funeral as they're talking about Jake's legacy?
Well, legacy is something I didn't really think about much until I had kids. And that's something you start to think about a lot. And it's early on, our kids are still learning to speak, and, we're going through potty training with our 3-year-old. But what I want to impart to them is being humble and being kind. And when I think about my legacy, no matter what people might think, if you're on your deathbed, the last thing you're saying is, I wish I would have worked more. I wish I would have made more money. You're not thinking about that. You're thinking about, I wish I would have spent more time with my family. I wish I would have traveled more. I wish I would have called up the buddy I haven't talked to for 5 years, because now it's too late. So being kind, being humble, and teaching our sons to be respectful and not entitled would be important too. I'm not so much talking about me here, which was the question. I'm more talking about how we want our kids to be. But I would want to be remembered as kind, humble, and having a positive impact on all the lives that I've touched.
Yeah, I love that answer. And I think of being a parent, a father, someone that has some influence, but at a short period of time. It seems like right now, I'm sure as you're in the thick of it, the adage of the days are long and the years are short. You're probably looking forward to getting through the potty training. But I will say that what I have a reflection of having kiddos that are a little bit older, but then also coaching youth sports and doing other things, is there's a lot of leading by example, and kids notice what you do. There's a phrase that a thought leader that I really enjoy has coined, which is more is caught than taught. And as you think about it, you can share all the different things verbally that you want with your kids, but they're watching you, they're watching your actions, and it's important to remember that. So great way to end our show, Jake. VanWest Partners, if someone's an accredited investor, if someone has an interest in maybe learning more about your investments, how do they get in contact with you? Do they have an ability to reach out to you and maybe talk about the investment business?
Yeah, you can email me at jacob@vanwestpartners.com. Hit me on LinkedIn, Jacob Vanderslice, or go to our website, which is also vanwestpartners.com.
Jake, thanks for being a great participant on our show. I love talking about different aspects of real estate. This show is going to be touching to a lot of different people in many ways. A real good cognitive, heady conversation, but also some good old-fashioned human development and discussion, which I really enjoyed. So for our podcast producer, Ann Russell, for our expert guest, Jake Vanderslice, I'm your host, Kyle Malnati. And as I love to say, we will see you around the neighborhood. Thanks, everybody.